It's great to see so many new people tuning in, along with a big thank you to those that have joined us each quarter since we've been running these updates. We really do appreciate your feedback around these sessions, as we want to make sure that they're as useful for you as possible, and we're trying to hit the right balance between your time and, of course, and the information covered. For those of you that I've yet to have the pleasure of meeting, I'm Tanya Hoshek, Head of Distribution for our advisor business. And now that spring has sprung and energy and optimism is returning across all states from our COVID lockdown winter, albeit still slowly for those in Victoria, it gives me great delight to update on our continued rollout of these portfolios. As you may already be aware, we announced last session that we went live on BT Panorama on the 31st of May. And as of the 1st of October, went live on Macquarie Wrap. So still continuing to provide you options in your business for how you can access these portfolios. So now we're fully enabled on those two just mentioned, along with Hub24 Net Wealth and Premium. We're also in the process of finalising in preparation to launch an ESG-oriented portfolio to add into the suite of managed funds or managed portfolios that we currently offer. So please watch this space for more information as we get closer. Thank you all for your support to date in seeing these portfolios as a quality solution to help your clients achieve their wealth management goals. And I have with us today Daniel Choo, the portfolio manager of the multi-asset strategies for Australasia, and in particular these managed portfolios. So he's here to take us through the last quarter performance and activity, and also importantly our outlook and positioning of these portfolios for the period ahead. We do appreciate your questions, so please feel free to submit as we go. Thanks, Dan. Over to you.
Hi, everyone. Thank you for joining us. So I'll kick on with what happened during the quarter, talk about performance, talk about our positioning, and also, how we're looking towards the markets and this volatile environment. So the key investment themes for the quarter, as you can see here, you saw the global reopening occur or progress in the Northern Hemisphere, in Europe and US, people traveling, starting to enjoy the freedoms of life, something that they've missed for quite a while. The vaccine rollout has accelerated. We're seeing that in Australia. High five to everyone in terms of getting those vaccine rates up. And things are kind of getting to normality in certain countries, but it's also uncertain in many other countries. In Asia, the vaccine rate has been slower, now picking up progressively, but things are still quite uncertain. If you look at a second theme in the middle of this slide, you can see the Fed starting to signal their taper. This is something I wrote about and talked about last quarter. When we were back in July, I was really looking towards the middle of August, and there was an event called Jackson Hole in the US, where the Federal Reserve talks about their plans, or it's an annual summit, talks about big picture, what's happening in inflation in terms of monetary policy. And not necessarily that event, but there were events after the Jackson Hole where they started to really talk about tapering. And tapering, what is tapering? Tapering is really slowing the amount of bond purchases that they're doing right now, and that will reduce the amount of stimulus going into the economy. And so they've talked about that, and that's what they plan to do. And we think in November they'll formally announce the tapering and how that looks like. And then finally, really China slowing down in terms of, we saw the property issues that they're having with Evergrande, the regulatory environment where they're clamping down on monopolistic behavior in technology companies, as well as the education sector, even healthcare as well. And so that's put a dampener on emerging markets. In terms of returns, you can see them at the bottom here. They look really small, right? 1.8% for Aussie equities. International equities, unhedged currency, return 2.8%. But those are still really good returns. Notwithstanding that we've had the ultimate bull market since March last year. 1.8% is still something to be happy with. If you look at A-REITs, that's up 4.8%. That's a sector we're overweight. We hold about 7% at the balanced 70-30 portfolio level. So that's done well for us. We're happy with that. We've got some commodities as well. We hold about 1% allocation to commodities via the dynamic real return fund as well. That was the top performer here that you can see 6.6% in that very light orange bar in the middle. And then in terms of credit, that's really just clipping the coupon. EM debt up 70 basis points, high yield debt up 1.2%. The loans, I've been talking about loans and how we've been tilting heavily into loans, up 1%. And that's been very helpful, especially in an environment where cash is next to zero. And then you look at bonds on the right-hand side. Actually, it's not much to look at in terms of the bar charts. There's 0.3% and 0.1%. That doesn't really tell the full story of how volatile things were for bonds. Bond yields fell 30 basis points. And by the middle of September, they started to climb back rapidly. And so that led to a sell-off in bonds in September. But things were very volatile during the quarter, even in equities. This doesn't tell the full story. They were initially very strong. July, August, all-time highs, all-time highs, all-time highs. And then in September, with the Fed tapering, with China being a concern, with inflation rising, with the uncertainty over the vaccine rollout in certain regions, those things were starting to mount as pressures. But I'll talk about how the performance of the funds withstood those pressures. September was actually a month in which we outperformed. So in prior quarters, I've been talking about how we've been performing on the upside with equity markets rallying, we've been outperforming. Well, in September, in a down market, we outperformed again. And so I've been very pleased with that. And so I'll talk about how we manage that. But before I talk about performance, it's really important to set the scene with our market outlook. So the market outlook here is aptly themed growing pains. I think every quarter we give a new sub-theme, but this is a sub-theme of the broader theme, which is a great reopening. We're still in the great reopening. Economies like Australia, like New Zealand, Asia, many countries, even the US is only just opening up to European travel without quarantine. I think last Friday or this Friday. And so things are still in the great reopening. And so this phase that we're in now is going to be the longest extended phase. It's going to take a while for people to get back to work, for supply chains to reopen, for inflation, wage inflation in general, it's spiking right now, but eventually it will normalize as the supply chains reopen. And so this greater reopening phase is going to be very extended. So please remember this major thematic that's happening. But the sub-theme about growing pains, what is this really talking about? For those who have kids out there, growing pains is about the muscular aches that kids have when they're growing up. And so this is similar to the economy. And I said it's aptly themed because the economy has to grow. The economy has to grow without the help of stimulus. It has to help without the Federal Reserve pumping in billions and billions and billions of dollars, without the government handing out handouts to everybody. So with this, there's going to be volatility. There's going to be uncertainty. And Q3 was a good example of that uncertainty. September, equity markets fell, bond markets fell as well, and volatility spiked. And so these growing pains are going to continue to occur as we progress. And I've talked about that in the last quarter. Part of the reason why we trimmed some of our equity risk in June of 4 months ago. And so, yeah, so this is what we're seeing, and we think this is going to continue. But ultimately, as you can see in our asset class views and our summaries, our market outlook is favorable for the medium term. We believe that growth assets will outperform defensive assets, that the business cycle and the economic cycle is going to be above trend for at least the next 18 months. So that's a good environment for growth assets. We think that government bonds are still very expensive despite the sell-off. And it's likely that the US dollar will continue to weaken. We favor non-US equities due to valuations and catch up in terms of the cycle. So for example, if you look at Asia, EM, now the vaccine rollout is starting to ramp up. Japan as another example. Korea, they're seeing high vaccine rate take up right now. We think there's going to be a catch up, and in Europe as well. So these are our views. They haven't changed much at all. You could copy it and paste whatever we talked about last quarter to this quarter, but short-term volatility, positive medium-term cycle. Here I provided a new slide to you all, and this is a schematic which shows different components of our portfolio. In the past, I used to provide a table, show you CBA, all the different stocks that we hold, all the way to AGL. Then talked about the dynamic real return strategy that sits in the middle of the portfolios, and then talked about the ETFs as well. But I think this is a cooler way of showing things and really to be able to look deeper into the portfolio. It's kind of like when you go to a doctor and they have that skeletal, person, and you can look inside and see the organs and all that kind of stuff. That's a version of this here. So if you look at the allocation within the balance managed portfolio, this is as at 30th of September, you can see our direct shares allocations here, CBA all the way to AGL on the left-hand side there. We use a multi-factor process in which we're allocating towards momentum, value, growth, low vol, and we do favor and quality, and we do favor momentum and value. And you can see each of the stocks, and I'll talk about this in deeper in 5 or so slides. We choose each of these stocks based on their characteristics. So we like momentum and value based on our research, and therefore these stocks, as you can see here, BHP is a momentum stock, and James Hardie, JHX in the middle there, is a momentum and growth stock. This allows you as advisors to talk to your clients in a easy, simple to understand manner, but which is also engaging. But I'll come back to that. In the middle section here, we have the dynamic real return strategy. For those who have been following along, we really think this is an important part of the portfolio for 2 reasons. Firstly, to gain access to managers that are not readily available on a platform. About 80% of the managers that you see here, from Sanders to Vinva to ICG to GLG to Amundi, they're not available on a retail platform. Based on our manager research capabilities and our global scale, we want to access a greater breadth of managers and select higher conviction managers. So the dynamic real return strategy that sits in the middle of these managed portfolios allows us to gain access there. The second thing that the MAG strategy, the multi-asset growth strategy fund, which is a dynamic real return core, allows us to do is to dynamically tilt between portfolios without creating extra turnover at the client level. So when I'm selling high yield debt and buying loans, as an example, I can do that within the MAG strategy without creating extra turnover at the client level. And then finally, we have the ETFs that round out the portfolio, and we hit a cost budget of about 65 basis points. That's investment fees plus model fees, underlying investment fees plus model fees. And you can see the return there in the bottom right. Hopefully that's given you a good reminder and overview of the strategies, but we can also provide all those standard tables if you require that. They're available anyway. So let's come to performance. So here you can see the performance for the quarter and the 1 year as well. Let's focus on the balance managed portfolio because I think that's easiest to focus on. So this is 70-30. I just talked about that strategy just then. The performance for the quarter was 1.7% net of model fees. That underperformed the Morningstar peer benchmark. It outperformed the, let me start again. 1.7%, it underperformed the Morningstar passive benchmark, but it outperformed the Morningstar peer median by 20 basis points. So this includes the whole universe of the active managers, Vanguard, etc. But then we also have the custom SMA peer group that they're made up of managers available on Hub24. And so we scanned through the different peers there. It's kind of the who's who. If you want to see that in detail, please reach out to your RMs as well, and we can show you how we've done there. And so we underperformed by 30 basis points relative to that peer group. Call it mixed relative to peers, but this return here of 1.7% again, in absolute terms, a good quarter for returns. And as I mentioned before, in September, in a down market, we outperformed by about 30 to 40 basis points relative to peer median, and relative to the benchmark, we outperformed by 90 basis points. So lots of volatility, but I'm happy that even in a down market, we've been able to cushion some of the downside I think many of you who have been dialing in since day one might have thought we're just ultra bulls, just sitting on the bulls, the long side here. But being able to show that we've been able to cushion some of the returns in a down market, yeah, that's been pleasing. If you look at the 1 year, it's more stark. It's more obvious what's happening. At 21.5% returns for the balanced managed portfolio, outperforming the benchmark, outperforming the Morningstar peer median, outperforming by the SMA peers on Hub 24. That's been really good. And for those who have been dialing in, it's really been the dynamic tilting that we've undertaken. So 2020 COVID-19 crisis, a great test, the greatest test probably of our process. And we've been able to not only outperform in the upside, but also more recently, I mean, there's only been one example of downside months, that's last month. We've been able to outperform as well. So pleased with that. Stock selection has also been positive in the direct Aussie equity piece that has outperformed its benchmark. Our managers have outperformed their benchmark as well. And those managers, as I mentioned before, we access them via the dynamic real return strategy. So lots of things to be happy about. This shows our cumulative returns since inception. So you can see initially we started in June 2019. We were doing well until the COVID-19 crisis hit. But then when the COVID-19 crisis hit, our dynamic real return strategy, our dynamic process really kicked in, and we bought equities, we bought credit, and we held for a very long time. And you can see that here, actually bringing out my pointer, my laser pointer. I feel like I'm in high school, university here. You can see that we bought around here, this point. So this is the 70-30 fund. And then we bought growth assets, and then we held for a very long time. Our contrarian signals, our quantitative signals were telling us that the market was very overbought around this time, so April and June, and we started to trim ahead of the volatility that we've just seen. You might be asking right now, sitting at just under 75% growth assets, what's next? Are we going to continue to trim? Are we going to buy back into these growth assets? And my answer to you, and please, instead of myself asking myself questions, please ask if you have any questions. The answer would be, we're waiting for a bigger reversal. And so if we see about a 10% reversal in markets, so downside reversal, if markets sell off by 10%, we'd be looking to add back to about the highs of what we've held in the middle of last year. So we'd be adding about 3 to 4% of equities. But if we don't see that reversal, which will be very unlikely based on the history of finance, and also it'll be amazing for your clients if we don't see a 10% reversal, because that would mean everyone's gaining in terms of their returns. If we don't see that, yeah, we're happy with where we're positioned, because we've got credit overweights relative to government bonds. We've got cyclical overweights. We've got the stock selection as well. But our standby position, our stance right now is to wait, be patient, wait for that reversal, a larger reversal than the one we've just seen, and then buy quite aggressively. So the main message here is, don't be surprised if there's volatility. We'll be buying into that anyway. And because our view is that the medium-term outlook is positive. I better start to go through these slides at a quicker pace. This is our absolute allocations for each of the 4 strategies that you can see here. We have a 30-70, 50-50, 70-30, and 90-10. And so this shows the asset allocations. This is really looking into MAGs and the real return strategies. So it's really important as portfolio manager on both the MAGs real return strategy and the managed portfolios that I look through into MAGs, and that's really important in terms of the process. On a benchmark relative allocation perspective, we are underweight global equities, overweight Aussie shares, listed infra, overweight Aussie REITs within here as well. But the main one that we hold right now is the overweight the loans and absolute return credit, as you can see here, and underweight the government bonds. There's a question Yeah, okay. I'll get to this question. This question is, what work has been done on the potential impacts of Evergrande and the issues for the portfolio? Was there any direct exposure to underlying manager positions? And so the answer to that is, yeah, it impacts our emerging markets positions. It impacts the overweight that we have in EM in particular. In terms of exposures to Evergrande, in terms of exposures to credit or even the stock, um, nothing there. So we don't hold that exposure. Yeah. I think what's more concerning for us in terms of our EM exposure is the slowdown in credit growth in China. And so for those who dialed in the last quarter, and I think we've got a recording somewhere, I mentioned that we had already been trimming EM in February. So even before Evergrande, even before the Chinese tech crackdown, even before, when Chinese stocks were making new highs, we were selling into that EM exposure, mainly because it was overbought and also because of this credit growth issue that we have been focused on. Alex Cousley, our strategist, we have a China team as well. We have a team of investment professionals in Shanghai. And Alex Cousley, our regional strategist, I've been working with them to analyze this more. They think that there's going to be more stimulus coming out of China to support the economy. And so the worst of the impacts of Evergrande and the credit situation is probably, we've probably seen that. But yeah, we still want to be a bit cautious. Moving on, this shows our asset allocation changes during the quarter. They're so minor. Look at this, like it's between -1% and +1%. I don't think there's much. Yeah, there's not much to talk about. This is market drift. When equity markets rise, the portfolios, the global shares allocations rise as well. And so there's not a lot to really focus in on here. But in prior quarters, we had been trimming equities, as I mentioned before. But there was a change at the sub asset class level. So within global equities, we made this change here. We sold the VEU and VTS ETFs and bought the VGAD ETF. What is that? We sold the global equity ETFs that are unhedged. They don't have any currency hedging, and we bought the global hedged ETF. And we wrote a note about this, and we've received feedback on this. And so let me try and explain why we did this. So effectively, when you hold global equities, they're unhedged most of the time. There's currency exposure. You get exposure to the US dollar, Japanese yen, euro, whatever, sterling. And so when the equities move, you benefit from that. And when the currency fluctuates, you also see currency translation losses or gains. So when the currency rises, when the Aussie dollar rises against other currencies, it means that we're gonna face currency losses. That's because the Aussie dollar is now strengthening against the US dollar. That means whatever you hold in US dollars, it has effectively weakened because it's weakened against the Aussie dollar. For those who own property or assets overseas, you easily understand this. And so what we did, or what we've been, our hedge ratio for a very long time has been 0%. And the reason why we wanted this is as a volatility dampener. The Aussie dollar tends to be cyclical in nature, and so when we hold less hedging in a down market, that's helpful because it helps diversify the portfolio. Anyway, what happened in the quarter is the Aussie dollar fell and fell and fell and fell. Iron ore was falling. We had lockdowns in New South Wales and Victoria, and there was a lot of pessimism focused in on the Aussie dollar. So what we did is for the first time in a very long time, we increased the hedge ratio, and we did that by selling ETFs that are unhedged and bought the ETF that is hedged. And what does that mean? It means if the Aussie dollar does rebound, effectively that will mitigate some of the currency losses. Yeah, so that's what we're trying to do here. Pretty standard for a multi-asset strategy to kind of toggle with the hedge ratios. I've got another question. Oh yeah. So then the question here, the next question, which I think relates to equities, is we expect more significant volatility. What is that time frame? Is it 6 months, 1 year, or 5 years? I would say right now, I would say 6 months. Yeah, that 10% fall could happen at any point in time. Yeah, and because of, as I said before, the growing pains coming out of the COVID crisis and trying to loosen the shackles, trying to really grow without the stimulus. That's something that is untested right now. But over the more medium term, we still have a positive outlook. The next slide shows the MAG's allocation since inception and the balance managed portfolio allocation as well. As I mentioned before, the second reason why we have the dynamic real return core strategy in there, and it's not second because it's low in priority, it's second because it's just as important, is to dynamically tilt between asset classes without creating extra turnover at the client level. So in March 2020 and June 2020, when we're buying equities and buying credit, we did that in the MAG's portfolio, and you can see that it translated and was implemented in the balance managed portfolio without seeing line item after line item after line item in terms of transactions. And this allows us to be very proactive and nimble in when we want to buy equities. We don't need to wait for a monthly rebalance. We don't need to concern ourselves. Are clients seeing too many trades at the portfolio level? Do we have to keep, writing out note after note after note on buying equities and credit? We're definitely writing the notes, but we're also, not creating that turnover. So as I always use March and April as an example. Last year, when equity markets are falling 10% nearly every 5 to 10 days, it allowed us to buy equities within MAGs, buy 1 week, buy another week, buy another week, buy another week, without clients seeing ETF after ETF after ETF after ETF being bought. And so, yeah, this is one of the benefits of having the MAGs strategy in there, a very important benefit as well. Moving on to the sundial. This here are the active managers within the MAG strategy, the dynamic real return strategy. This sundial here shows the external managers. I already previewed this in the previous slide, but again, Sanders, Numeric, Nisse, these are global equity managers. I think you'll be very familiar with the Aussie equity managers: Vinva, Allen Gray, Firetrail, Platypus, kind of the who's who of Aussie equity. But Vinva is institutional only, so they don't have a retail strategy. Again, getting access to managers that we have higher conviction in. And then on the extended fixed income side, I've been calling this the income generators. These are the managers that are yielding about 4 to 5%, previously yielding 10% last year. The yields have dropped tremendously. And these are our income generators. Metrics is an Australian loans manager, ICG, a European loans manager. In this really small segment here that you can't even see the name here, it's a high yield debt. We used to have a lot more of high yield debt. It probably was the size of Metrics that you can see here. But what we've done is we sold high yield debt and we bought the Metrics ICG 24 loans and absolute return fixed income allocations. And this is really, again, focused on valuations. Valuations are very expensive in high yield debt. Previously, you could earn a yield of 10%. Now it's more like 4%. And to take on the interest rate sensitivity and the sub-investment grade credit risk, we don't think that's a risk worth taking. And so we've rotated towards loans, which are more senior in terms of the debt on the balance sheet, the more senior in terms of the credit. And so in the case of default, these loans managers will be paid out first, generally. And so, yeah, we've been rotating there. And you can see the allocations within the MAG strategy of the external managers here and the performance. So for the 3 month, you can see that our equity managers have underperformed for the 3 months. So global global managers here. Vinva is the Australian equities manager. They've underperformed in general. That really was due to some of the FANG stocks doing very well. And even in Australia, we saw banks do quite well as well. And so they underperformed, but for the 1 year, we've seen strong performance during the 1 year. And we can share more information on this as we go on. And then this comes to our direct shares holding. For those who are new to the course, why do we have direct shares? It's really demand driven. Clients want to see their Australian clients love to see the direct share portfolios. And Russell Investments, we have a tried and tested methodology of investing in a multi-factor approach. We're not deep value or value orientated or growth orientated only. It's using a diversified approach to investing in the factors that we prefer. And so we have 30 stocks today. This can fluctuate between 25 and 30. CBA, as I mentioned before, that's a momentum, value, and low vol stock. I'm just picking out some of these. Suncorp did very well during the quarter. It's a value stock with low vol. A stock that didn't do well was Altium. That's a quality and growth orientated stock as well. And then you have AGL that has really underperformed for quite a while now. That's a pure value stock. I put this little diagram, I put this little snippet here in the bottom. It's way too small for anyone to see, but it is an example of additional material that you can gain access to via your RMs to look at how our top 5 and bottom 5 stocks have performed and the rationale for that. So here I list out with our Aussie equity portfolio manager some of the reasons why South32 has outperformed. Aluminium, as an example, is in a massive supply crunch, and so spot prices have rallied to the moon, and South32 has benefited from that. Suncorp, Macquarie, done very well from earnings season. And then the bottom 5 are made up of Fortescue, Rio, BHP. Anyone who can draw the thread between them would know that iron ore is a big driver of that. So iron ore has collapsed during the quarter. So please reach out to your RMs if you want this material, and that will might help you engage with clients more as well. And in terms of performance for the quarter, flat. And so all these crosses were offset by the positives, and over the longer term been outperforming. And again, you can see the commentary here. But this is really a multi-factor approach, diversified. It takes a long time for the factor active performance to kick in. Another way to rephrase that is we got to be patient to see factor performance. And these are based on our quantitative research that we've done. And this portfolio was rebalanced in June and will be rebalanced again in December. So it has a semi-annual rebalance. Let's close. So coming to the growing pains. The growing pains has two different, it's a juxtaposition, isn't it? It's growing, but it's also painful. The economy is growing, but in the short term, it might be painful. So as I mentioned before, we correctly anticipated some short-term volatility. Again, looking at those central bank events, it was quite obvious that there was going to be some volatility in terms of the announcements. Bonds have sold off, equities have sold off. More recently, they've rebounded in the last week. This is October 2021 that I'm talking about. But the recent 5% pullback has not been big enough for us to buy into. A 5% pullback is stock standard. Every calendar year, for the most part, we've seen a 5% pullback. We really need to see something larger than that for us to be even tempted to add back into equities. We're still positive on the medium-term outlook. The cycle is still expected to be positive in terms of its above trend growth. We believe that the global economy will come out of its rut in terms of, well, it already is, but there will be more countries joining the US, Europe, even Australia is doing very well in terms of economic growth. Most people will go back to their offices. Most people will go back to the shopping malls and shop. The vaccine has changed things. There's even therapeutics that are they've cancelled stage 3 clinical trials and gone straight to FDA approval. There's things that are on the horizon that we see that support a more positive outlook. But I think what's really important here is we stand ready to buy into equity markets. And so if we see that 10% drop, do not be surprised. We're not panicked. We expect it. We expect there to be a 10% reversal at some point in time, and we'd be buying into that. And so with that, I will stop there, hand over to Tanya, invite any questions. But if you want to reach out to anyone here and to see more of the material, to talk about the process, to give us feedback, yeah, we'd really, really appreciate that. So back to you, Tanya.
Great, thanks, Dan. I really appreciate the information you provided and your insights. We are well out of time, so thank you all for your attendance. If you do have any questions that you didn't put forward today, please reach out to myself, Terry, or Ross, and we'll get back to you as quickly as we can. Thank you for your support. Have a wonderful day, and we'll be speaking to you soon. Thanks.